Let's start with grand revision for financial management. This is your instructor, Rizwan Maniya. Guys, financial management paper obviously requires the mindset of a finance manager. So you need to remember that you all in this paper are financial managers, okay? So you need to think like a finance manager, and what functions does a finance manager performs. This is what you have to keep in your mind. So you are all finance manager. Now, the first work that is performed by the finance manager is that finance manager will take investment decisions. Investment decisions, which means you have to take a decision as regard where you need to invest the company's funds. So whenever one says investment decision, we need to keep in mind the steps of capital budgeting process. And the steps of capital budgeting process includes IFA SMC. Now what is I? I is identify the capital investment requirement. What is F? F means find the suitable options to fulfill the requirement that you have identified earlier. Then you have appraise. Yes, after you found out different projects, you have to appraise which is the best one. When I say appraise, now you have to use investment appraisal techniques like ARR, like IRR, like NPV, like Payback, as you can see in front of your screen. So appraisal means by using these techniques which you are seeing here, you will appraise the best project. And after that, S means select the project, M means make the expenditure, and C means continuously monitor the results of this project to ensure that those results are in accordance to the plans that you have made, the budget that you have planned. So this is IFASMC. Now, as I mentioned that there are 4 investment appraisal techniques. Yes, it's 4. First is accounting rate of return. ARR is a profit-based technique. You need to listen very carefully whatever I'm saying here, okay? ARR is a profit-based technique. So if it is a profit-based technique in which you need to work out profits, you may be given in the examination with cash. So you need to convert those cash flows into profits. Now, how do we convert cash into profits? So you should know that if we want to convert cash into profits, so we will deduct depreciation from cash and then we will arrive at profit, okay? So what is accounting rate of return? It tells you the expected profit percentage earned by the investment, how much % profit the investment will earn. So there are 2 formulas we use in ARR. The first is initial investment method. The formula is profit before interest and tax. Come on, revise with me, recall with me, and write in the comment section below. So it's profit before interest and tax divided by initial investment multiplied by 100. The other formula is average investment method, where we say profit before interest and tax divided by average investment. But here, it's very important to remember whether it's initial investment formula or it's average investment formula, the PBIT should be average PBIT for all the years. If the project life is of 3 years, then 3 years average you have to take here. So, as I mentioned, the second is average investment method, where you will take PBIT average divided by initial average investment. And how do we work out average investment, guys? Come on, recap with me. The formula of that is initial investment plus scrap value divided by 2. Yeah, it's plus scrap value. You need to remember, you need to add scrap value and divided by 2, you get the average investment, and using that you work out the ARR. Now, if the ARR answer is more than the hurdle rate, the required rate of return, the target rate which is given in the question, this means the project is viable. This means the project should be accepted. Coming towards the positive of ARR. What are the positives of ARR? So one would say ARR is easy to understand because it is based on accounting information, and non-finance professionals do understand ARR very easily because it's a percentage profit return. But on the other hand, when I say people who are against ARR, they criticize that ARR is not cash flow based. Yes, for shareholders, cash flow based is important. Secondly, ARR ignores the impact of time value of money. You know that it is not cash flow based, so it will not discount the cash flows as well. Moreover, you need to keep in mind that ARR basically is profit based, so there can be variations in the results that can make comparison difficult using ARR. And yeah, we should all know that it is not an absolute measure, it is not an absolute profit return that is indicated by ARR. It provides you a percentage based result. Okay, so these are the drawbacks of ARR. Now let's move towards cash-based techniques. So the other cash-based techniques includes payback, discounted payback, which is part of payback, NPV and IRR. Now I'm moving towards payback. What payback indicates? Payback is a cash-based technique. It indicates how much time the investment will take to cover its initial investment. So time period where it will reach its break even is indicated by payback. When I say payback, so I would say the advantages of payback includes that it is simple to calculate, but yes, payback allow you to identify the inherent risk in the project, because an investment that will result in break even at a later year compared to the other investment that will bring in a break even earlier. So this means the project in which break even will come in later years is basically a risky project. So because of this, you can rank the projects, okay? But on the other hand, payback has certain flaws, like simple payback doesn't cover time value of money. Plus, it does not account for the cash flows that will arise after the payback period. Yeah, in payback, we are just restricted towards the answer of payback. That is, we get the answer, we say okay, but we are not concerned whether the investment will give you more returns after the payback. That is something we don't consider. Having said that, simple payback doesn't account for time value of money. So we have another method known as discounted payback. Discounted payback is different compared to simple payback in such a way that discounted payback uses discounted cash flows, which means it does considers time value of money. So what is time value of money? The concept is with time, money loses its value. As your cash becomes older and older, it will lose its value. Why? Because of inflation, because of interest impact, and because of risk factor. So with time, it loses its value. So now we need to incorporate time value of money. So we use discounted payback, we discount the cash flows, and on the basis of that discounted cash flows, we use that cumulative approach to find out the answer of payback. So what advantage does discounted payback brings? The obvious advantage, which is superior to simple payback, is it considers time value of money. The other advantages remains the same as of simple payback. But what additional drawback comes here is that obviously because it uses discounted cash flow, so you need to have cost of capital in place. So cost of capital is an estimate which may be wrong. Having said that, we have the third technique which is superior to all, known as net present value. It's NPV. Friends, NPV is very important technique. What is NPV? NPV is basically difference between present value of cash inflows and present value of cash outflows. So NPV, if it is positive, the project should be accepted. Why? Because the interpretation is it is covering the cost of capital and it is also generating wealth for the shareholder. So the amount by which your NPV is coming positive, it is the amount by which the shareholder wealth is being increased. Okay. On the other hand, if the NPV answer is negative, this means it is not covering cost of capital. And obviously, if it is not covering the cost, then one can be very much sure that it will not obviously increase the wealth for the shareholder. Now, the third possibility that my friends should remember in examination, all the finance managers should remember in the examination, is that if the result of NPV is 0, come on, do you know what to do? If you know, just write in the comment section below. If the NPV result is 0, so what should we do, friends? Come on, you need to tell very quickly. You need to ask yourself. So you have two options, either to accept this project or to reject this project. So how will you decide? So it's very simple. If you have some other positive NPV project available, so obviously you go for that. But if you don't have, then you will invest in this particular project because it is covering minimum cost of capital. It is covering the minimum cost of shareholders. Now let's move towards the complexity and the complex calculations that are tested in our paper. So my friends, remember, NPV assumptions are really crucial. The assumption number 1 is investment will be shown in year 0. Assumption number 2 is in NPV calculation, we will not consider interest cash flow because interest cash flow is already part of cost of capital through cost of debt. Third is any cash flow that is being arise at the start of the year, we will assume that to be seen in the last year, which means any cash flow that will arise at the start of the year will be shown in the previous year. But any cash flow that will arise at the end of the year will be shown in the respective year. Okay. Now coming towards some calculation aspects of NPV. What to do for fixed cost in NPV working. So I did mention this in my regular online classes a lot of times that fixed cost might be irrelevant because it is sunk or committed cost for the project, or it might be relevant for the project because it is an incremental cost. So when it is an incremental cost, you need to remember that there could be also a possibility to inflate the fixed cost in the question, and also there might be a possibility of step up in fixed cost as well. Okay. So having said that, fixed costs possibilities, now moving towards the next aspect, and what is that? So let's have a look. The next aspect is inflation. So in NPV calculation, you get to know two inflations. One is general rate of inflation, as you can see, and one is a specific inflation. So what is general inflation? General inflation means that there will be one rate for all. One rate for all. This is general rate of inflation, which means selling price, variable cost, fixed cost, all will have one rate of inflation. But when you have separate inflation rates for selling price, for variable cost, for fixed cost, so that is known as specific rate of inflation. So it's very simple rule of thumb you have to remember that inflation is of two types, general rate of inflation or specific rate of inflation. By using these inflation rates, what you do? You convert real cash flows into nominal cash flows. So, sir, what is a real cash flow? Real cash flow is a cash flow in which there is no impact of inflation. Okay. So, what is a nominal cash flow? Nominal cash flow is a cash flow in which you incorporate inflation either through general rate or either through a specific rate. But here, one rule of thumb is really important to remember. And what is that? If your cash flows are in real terms, so you will only discount those cash flows using real cost of capital, which is also without inflation. But if your cash flows are in nominal terms, which means with inflation, so you will only discount those using nominal cost of capital, which is again with inflation cost of capital. A question might ask in the paper to convert real cost of capital into nominal cost of capital, and the answer to that is, guys, what? It's Fissure effect. The formula is 1 plus n is equals to 1 plus r into 1 plus I, where I is general rate of inflation, where R is real cost of capital, where N is nominal cost of capital. Having said that, then we have another working here that relates to working capital. So yeah, in NPV, working capital might come in the paper. So you need to remember 4 points relating to working capital. The first is the outflow of working capital will always be shown in year 0. Okay. Second thing is working capital will be adjusted for inflation. So a question might come where you need to adjust inflation in working capital, either through general rate or specific rate. Third, working capital requires adjustment due to business expansion and reduction as well. For example, if your sales will grow, which means you need more working capital. So you need to increase working capital, incremental working capital will be worked out, and likewise, your business might go down, the sales might go down. And if it is the case, then your working capital need will go down as well. Okay, so you need to make sure an adjustment of expansion will be required. And the last is, in the last year of the project, whatever you have invested in the name of working capital will be shown as an inflow, except the project is in perpetuity, which means if the project is an ongoing project, will continue. So in that case, obviously, no need for that inflow. After working capital, we have a very important adjustment of taxation. So yeah, taxation working is important. So I think you need to remember very simple 3 points for taxation. Number first is that in taxation, a question that is taxation based, you need to work out tax payments for your taxable cash flows. So you have your taxable cash flows, obviously you need to pay tax on that. So taxable cash flows are subject to tax payments. Secondly, the tax authorities will give you capital allowance. Now, what is capital allowance? That is that when you make an investment, the tax authority wants to give you an attraction to make investment in the country. So they allow you capital allowances on the amount of investment that you have made, which means in short, they give you tax savings on the amount of investment that you have made. So that capital allowance will be worked out either using straight line method or it will be worked out using reducing balance method. Okay, so if it is straight line, you can do straight line workings. If it is reducing balance base, you will work out using reducing balance base. But in case of reducing balance base, I need to highlight one thing, and that is remember my friends, if you are using reducing balance bases, in the last year of the project, you need to work out balancing charge or balancing allowance. Balancing charge or balancing allowance. So how do you work out balancing charge or balancing allowance? So it's very simple. You have amount net of all capital allowances. You deduct scrap value, you get the answer. If the answer of balancing figure is a positive one, so that is known as balancing allowance, and if the answer is negative, so it is known as balancing charge. So capital allowances are important. Very important thing I have discussed a lot in my regular online classes is that in case of capital allowances, you need to look when the investment has been made. So there were 3 cases that I mentioned to everybody. If investment is made at the end of year 0, so you will get the first capital allowance in year 0 and tax saving as well. But if investment has been made at the start of year 1, so in that case, your first capital allowance will be in year 1 and the resulting tax saving will also start from year 1. If nothing is mentioned in the paper as to when you should claim the first capital allowance, so by default you will use year 1. In year 1, you will show the first capital allowance, and yes, the resulting tax saving will also be shown in year 1. But if there is a game of arrears, so remember, things will change a bit. In case of arrear, any respective tax saving or tax payment will go 1 year ahead. Anything that relates to year 1 will go in year 2, whether it's a tax payment or it's a tax saving. Okay, so arrears is important to consider. So having said that, these all are important things that we face in NPV calculation. So what results will NPV, what positive results NPV will provide? So the positive advantages of NPV includes that NPV is a cash-based technique and shareholders prefer cash-based technique. Secondly, NPV is an absolute technique, which means NPV is the amount through which you figure out the absolute gain, how much shareholder value creation will be done. So it's an absolute method of telling you the gain. Third, NPV considers the entire life of the project. As you all know, we consider the entire life of the project, okay? On the other hand, there are drawbacks, and the major drawback of NPV is assumptions. Lot of assumptions are used in NPV in relation to the timing of the cash flows, in relation to the project life. So obviously you assume 4 years life, you assume cash will arise in year 1 and this is the amount, year 2 this is the amount. So there are lots of assumptions that can have a big question on NPV. Now moving towards the fourth investment appraisal technique, and that is known as IRR, okay? IRR. So what is IRR? IRR is internal rate of return. My friends, IRR is a technique that indicates you break-even cost of capital. Through IRR, you figure out that percentage of cost of capital that results in a break-even, okay? So how do you work out IRR? Come on, do you know the method? If you know, quickly write in the comment section. Come on, guys. What is the method through which you work out IRR? So the first thing that you do is you first work out positive NPV. After that, you work out negative NPV, ideally, and then you input the answers of positive and negative NPV in the IRR formula, and then you get the answer of IRR, okay? So if you get the answer of IRR, what it indicates and what decision you take. So let's start first with the decision of IRR. So a very simple decision rule is, if IRR is greater than the cost of capital, the project should be accepted, okay? It should be accepted. But if it is less than that, so it should not be accepted. So actually IRR indicates that cost of capital where your project will show break even, okay? Break even. So now let's coming towards the positive of IRR. What are the positives of IRR, okay? So the positive of IRR includes, number one, IRR is a cash-based technique. It considers the life of the project. Decision-taking IRR is very simple, as you just compare IRR with cost of capital and you get the answer of that, okay? So yeah, it is something that definitely indicates you a very simple decision-making method, because you just compare and take the decision. But despite all these positives, IRR has some serious drawbacks, and one is IRR does not deal with non-conventional cash flows. Now, these are very important for your OTs. What is non-conventional cash flow and what is a conventional cash flow project? Conventional means in year 0 there will be outflow and then followed by years of inflow. So what is a non-conventional project? Which means that in year 0 there will be an outflow, then inflow, and then again outflow is a possibility. So when there is non-conventional project, IRR will result in multiple IRRs or no IRR, and that is where its usability is restricted. Another problem with IRR is it is an estimation method. In IRR we use interpolation method. It's an estimated result which may lead to wrong decision. Third problem of IRR is that if there is a case of mutually exclusive project. Now you know what is a mutually exclusive project? Mutually exclusive project means that when you have to take a decision between one project out of two, okay? So in that case, if NPV is supporting one project and IRR is supporting the other project, so we will go with NPV, as NPV is a more superior technique to IRR. So yeah, NPV will be given preference, and here IRR will become inferior. So in a mutually exclusive project, NPV is given preference over IRR, ARR. Okay, so these are the 4 investment appraisal techniques that I've mentioned here. So I hope up till now things are going good. It will be a 1-pager summary of entire financial management. Guys, I hope up till now it is giving you the confidence and things, you are able to recall. If yes, if you're happy, just write in the comment section below how it is going up till now. Is it going good or not? Please just mention in the comment section. Up till now things are being covered in the right way. Is it going good? Is it helping you to recap the things? It is helping you to increase your confidence. Okay, so let's move on then. First buy option. So the first cash flow buy option is what? First cash flow buy option is investment and its scrap value. Second option is capital allowances. Third option is maintenance cost. Fourth option is tax saving on maintenance cost. Okay, so remember the assumption that we have to take in buy option. The assumption is that the company will buy the machine by getting a bank loan. So you will get a bank loan, and from that bank loan you will buy the machine. So this is the assumption here. The second option we have is leases. Now there are 2 types of leases. One is operating lease, second is finance lease. Before I say anything, if you are getting the hint, write yourself. Okay, so operating lease and finance lease. If I start with operating lease, so in operating lease, from theory perspective, you need to remember that lessor is the person who is the owner of the asset. So asset will be shown in the balance sheet of the lessor, and lessor will benefit the lessor will get the benefits of the asset, and as well as lessor will be facing the risk of the asset. So risk and rewards will be with the lessor. Because lessor is the owner, the maintenance will be done by the lessor, and the time period of the deal is a short time period. Okay, now what cash flows do you need to remember in case of operating lease? So the first cash flow that you need to remember is, guys, it's the lease rentals. Number 2, it's tax saving on lease rentals. Okay, the third is finance lease. From theory perspective, lessee basically is responsible for the risk and rewards of the asset. Maintenance is conducted by the lessee. It's for the significant life of the asset, and yes, it appears on the balance sheet of the lessee. Okay, having said that, now coming towards the next very important aspect, that what cash flows are important. So number 1, in case of finance lease, the first important thing is the finance lease rentals. Number 2, tax saving on lease rentals. Number 3, because you are the owner of the asset, being a lessee, maintenance and servicing is your responsibility, and yes, you will get tax saving on that, so that will also be a relevant cash flow. So now what we do, we compare buy option cost with operating lease option and with finance lease option, and we go for the lowest cost option, and we decide whether we need to buy the asset or we need to gain through operating lease. Very important thing that I've mentioned in my regular online classes is that, remember my friends, in case of operating lease, whether it's a finance lease or it's an operating lease, what you need to remember is, yes, when the rental will be paid. So there are certain cases to remember. So the case number 1 is rental will be paid at the end of year 0, or it will be paid at the start of year 1, or it will be paid at the end of year 1. Considering the time period, you will do the respective treatment for tax saving of rental. Okay. The next decision that relates to this investment is known as asset replacement decision, a decision in which you decide when it is best to replace the asset, after every 2 years, after every 3 years, after every 4 years. Okay, so what you have to do, you have different options of 2 years, 3 years and 4 years. You simply work out the NPV of each replacement cycle. I repeat, you work out the NPV of each replacement cycle, and then you work out equivalent annual cost or equivalent annual benefit. You work out EAC or EAB. Now, if you're working out EAC, you go for the lowest EAC option. But if you work out EAB, you are going for highest EAB option, okay? Then the third decision you have is capital rationing. Yeah, what is rationing? Rationing means restriction on funds. Why the funds are restricted? Why business cannot maximize the shareholders' wealth? So the first reason is hard capital rationing. If you can recall, please write in the comment section. Hard capital rationing means that restriction is placed by external factors. Now, example includes, number one, because of highly geared company, bank is not giving you the funds. Number two, because there is an economic recession, you cannot get the funds from the market. Number three, your poor trading prospect is becoming the reason because of which people are not giving you new funds. The second major group of restriction is soft capital rationing, which means that restriction is placed by internal management. Why? Number one, to promote ranking, to select the best option. Number two, to avoid further interest payments because you don't want to further pay the interest. Number three, to avoid further dilution of control by getting new equity into the business, okay? So how do we deal with this rationing? How do we deal with this single period rationing? So it's very, very, very simple, my friends. You have two methods. Do you remember the methods? If you remember, write in the comment section. The first method is known as Profitability Index. What you do? You work out Profitability Index for each project. On the basis of PI, you rank the projects and then you allocate the funds. But for Profitability Index method, you need to remember a very important assumption that project is considered as divisible. But if the project is indivisible, what I'm saying, guys, if the project is indivisible, so in that case, what method do you have to follow? Do you know the name? Just write in the comment section. The method is trial and error method. So what we do in trial and error method, the first thing that we do is we find out different combinations, okay? Different NPV combinations, keeping in mind the investment, and we select the highest NPV combination. There is a very important assumption you need to remember. Whatever highest NPV combination you have used, and if your funds are not completely utilized because of that highest NPV combination, so the assumption is the amount that is unused, the amount that is unutilized will be invested at least cost of capital. So these are the three investment decisions that you take in under this heading. Then the last area of investment decision and investment appraisal is risk and uncertainty. Now, investor is facing risk when you are taking a decision about the investment. So if you have probabilities available, it is known as risky situation. If you don't have probabilities available, it is known as uncertain situation. So how do we deal with this? The first method we have is sensitivity analysis. What sensitivity analysis does? It identifies the most critical variable which, if changed, will have an impact on your final decision. So sensitivity analysis identifies the most critical variable. So how do we work out sensitivity of different variables? There is a very, very simple formula, which is NPV divided by present value of cash flows under consideration, which means if you're working out the sensitivity of selling price, you use present value of sales revenue. For variable cost, you use present value of variable cost. For fixed cost, you use present value of fixed cost. For contribution, you use present value of contribution. For investment, you use investment. But what about sales volume? So if you're required to work out the sensitivity of sales volume, you use what, guys? You know the answer? That is, we use present value of contribution. And then for cost of capital, we take help of IRR. So it helps in identifying the most critical variable. The smaller the percentage change, the more critical the variable will be. And yes, one more thing. Remember the tax impact in calculating sensitivity analysis. So if I say what advantages will this provide you? So I can easily say it identifies the most critical variable for the business. But drawbacks are really important, And the first is it is not using probabilities, okay, chances of occurring an event. And second is it assumes that one variable will change at one time, which means it says that if there is a change in selling price, so there will be no change in the other variables, okay. And the third very important drawback is it does not incorporate risk into investment appraisal. All these points will help you in your exam when you have to write theory in relation to positive and negatives of sensitivity, okay. So examiner does says that discuss the method of sensitivity analysis in measuring or in incorporating risk into investment appraisal. So remember, sensitivity analysis does not incorporate risk into investment appraisal. Reason, it does not use probabilities. Having said that, the other technique that overcomes this flaw of sensitivity is probability analysis. Probability analysis is a technique that uses probabilities. It uses expected value technique through which it incorporates risk into investment appraisal. So what is expected value? It is the weighted average outcome. It provides you weighted average NPV. So what positives does expected value of NPV has? It's very simple. It is a technique through which you can take a decision. I would say it is a technique which is known as objective one. So you have the decision, you can take the decision very simply by looking at the NPV. So it's a decision rule actually. But the negatives are that probabilities might be wrong, might lead to wrong decisions as well. Expected value is basically a technique that is used by one type of decision maker, and that is risk neutral only. But yes, the most important advantage is that it incorporates risk into investment appraisal. The other techniques that deal with risk and uncertainty are simulation, which considers multiple variable changes, and the last is risk adjusted cost of capital that we'll cover right now once we reach cost of capital. So this is the first function that we are done here that finance manager performs is investment decisions. I hope the entire investment decision area is complete. Now coming towards the next crucial work that is performed by the finance manager, and that is taking financing decisions. What is that, guys? Financing decisions. So what financing decisions the manager takes? What options are available? So the first option is obviously equity. First source is equity. So in equity, the first option is retained earnings. Yeah, retained earnings is the best option. It is cheaper. You don't have to generate this. It is cheaper and it is available all the time. The second source of finance is right issue. What is right issue? Which means the company is offering its shares at a lower price, compared to the market to attract the existing shareholders only to raise the funds, okay? So in right issue, there is a concept of theoretical X right price known as TERP. So you work out theoretical X right price, and what is TERP? Basically, TERP indicates theoretically what the price should be once the right issue has been made, okay? So this is TERP. So what options right holders has? You should remember. Come on, do you know what options right holder has? Can you write in the comment section? Number 1, take up the rights. Number 2, sell the rights. Number 3, partially take up the rights or sell the rights. Number 4, do nothing. Now, out of all these options, do nothing results in dilution of the wealth of the shareholder. You should know that. Whereas all other 3 options will not dilute the wealth of the shareholder. But out of the first three, the best is, come on, you know the best one? The best is take up the rights, okay? Because shareholding will not be disturbed because of that, and in future obviously they will receive higher dividend returns as well. So this is right issue. Then you have new equity issue. Now, do you know what comes under new equity issue? Yeah, there are 2 things. Number 1, placing. What is placing? Selling shares privately, okay? So you sell your shares privately to a bank maybe, and that is basically not done through SEC, Security Exchange Commission. So without SEC, you are selling the shares privately to some company or a firm. So here you don't require prospectus because this is done on a private basis. Normally SME will use this. Then you have the other one. And what is that? The other one is known as a place public offer. So what place public offer does? Which means you are selling your shares at a large public. You're selling your shares through a stock exchange to a large public, which means you are gaining lots of funds by selling the shares in the public at large, and this is done through stock exchange, obviously, which requires the need for prospectus as well as proper documentation or proper registration with stock exchange. So this is public offer. In this public offer, there are two things to remember. One is IPO, which is initial public offering. Now, once you register on the stock exchange for the first time, you are required to do an IPO. What is that? That is first time you will offer your shares to the public. Okay, this is IPO. And after that, if you're doing this again and again and again, so that is known as subsequent offering, where you're issuing your shares to the public after the IPO. So this is the third important source of equity, which is known as new equity issue. Now, remember, for taking decision of equity sources of finance, we have a very good mnemonic known as ACCAP. ACCAP. So what are the quick things? These are the factors you have to keep in mind when you are taking a decision, whether you have to go for retained earnings, whether you have to go for right issue, whether you have to go for new equity issue. So these are the 5 factors to consider. Let me give you a quick recap of this mnemonic. A, obviously availability. You will look what sort of funds are available to you as a company. Number 2, C, basically deals with the cost, which source is basically cheaper or expensive. So you should know that public offer is most expensive and placing is cheaper. Then you have the next one as control. So dilution of control will be highest in public offer, and it will be lowest in right issue. In fact, not at all, okay, if all the existing shareholder will take up the rights. Then you have another A here, that is the amount of finance that you require, depend what amount you need, and you can use different sources accordingly, because if you need a huge amount, you need to go for public offer. And then pricing of the shares. So yeah, public offer has the highest price of the share in the market compared to placing, which has the lowest price, because you are not using a stock exchange in that. So based on these ACCAP 5 factors, you take a decision as to which sources of equity finance are useful. And remember, these will help you in drafting the theory. Now coming towards the second major source of finance, known as debt finance. So what is debt finance? The first is debentures. Now, debenture is basically a type of a bond. So there is a term bond, and the first bond is debenture. This is a bond where company issues the bond without security, without giving anything as a security, because of the general credit worthiness of the company. Second you have is deep discount bond, which means that company will issue the bond at a discount, okay, and in return company enjoys lower interest rate. Then you have zero coupon bonds. This is a bond in which company issues the bond to bank or the public at a very high discount, and then in return there is zero coupon, which means there is no interest over the life of the bond. Then you have convertible bond, which is known as hybrid bond, which includes the components of equity and debt. So you all know what is convertible bond. Company will issue this bond to the bank and will give bank the option after 2 years, after the maturity of the bond, maybe 5 years later, 6 years later, whenever the maturity is, bank has the option to convert that debt into equity. Bank can become the shareholder of the company, okay? And then we have loan note with warrants here. So this is again a hybrid bond. So what is loan note with warrant? Remember, loan notes with warrant is separate to convertible debt. In loan note with warrant, the company issue bond to the bank at normal market, okay, and then the company gives bank the option that after 2 years, after 1 year, you can buy our shares at a lower price, and for that you need to pay us for cash, okay. So if bank is interested in company getting the shares, so bank will pay for the shares in cash at a lower price, but the redemption of the bond will be done in the normal way. Company will return the loan to the bank in the normal way. So this is loan note with warrant. So these are 5 types of bonds, which is type of debt sources of finance, okay. The other debt sources of finance includes these five are basically types of bonds, okay. The other types of debt finance includes bank loan, normal bank loan, which is a non-tradable bank loan, okay, because bonds are tradable, and leasing, finance lease, operating lease, and other short-term debt finance includes trade credit, okay, and bank overdraft as well, okay. So these are the different sources of debt finance. Now when you have to take a decision whether to use bonds, these 5 types, or go for a bank loan, or go for trade credit, or go for bank overdraft, you have factors here to consider, and the mnemonic of the factor is known as SAID. Now what S is? Before deciding which type of debt to use, you look at the security. S stands for security. For which type of debt you need to give security. So you look at the security. As I mentioned, debentures has no security. Then you look at A, that is amount of debt finance needed. So according to amount, you decide which option is better for you. Then you look at the interest rate. Either interest rate you are getting is a floating interest rate, which means it will change according to market rate, or it is a fixed rate of interest, which means it will remain fixed irrespective of the market. And last is the D, that is duration of the loan you needed. So according to duration, you decide whether you have to go for bank overdraft, which is a short-term debt finance, or you have to go for bonds, which is a long-term source of debt finance, okay. So the second source of finance is debt. Having said that, you have option of debt and equity. Now you are coming towards here CD-RAC. So what is CD-RAC? CD-RAC is another third area of factor that helps you to take a decision whether you have to go for equity or debt. Now when you have to take a decision whether to use equity or to debt, you have CD-RAC. So what is CD-RAC? C stands for cost. Obviously, debt, you know, come on, you can write in the chat box, you can write in the comment section. Debt is a cheaper source of finance. So C is cost. Debt is cheaper, whereas equity is expensive. Now why debt is cheaper? Because you should know that on debt, the risk of the bank is low compared to equity investor. So bank requires a lower return. Secondly, on interest, the company gets tax saving on debt. That is why the cost of debt goes down compared to cost of equity. So cost wise, debt is cheaper, equity is expensive. Then you have D, again duration. If you need for a very long time period, you go for equity, otherwise you can go for debt. Then you have R, which is risk and return relationship. Risk and return relationship. So you know, the more the risk, the more the return, the less the risk, the less the return. So yeah, in case of equity, from company point of view, if you think about equity, so equity is, yes, less risky for the company, as company is not required to return it, but the return on equity is less because equity is a cheaper, expensive source of finance. Compared to debt, debt is more risky for the company because company needs to repay the debt, but the return on debt that company gets is better because the cost of debt is less than the equity, okay. Then we look at A, which is accessibility, how easy it is for you to avail debt or equity. Then you decide whether to go for equity or debt. And last is G, that is gearing. If you are a highly geared company, obviously debt will not be a good option and you need to go for equity. So ACCA are the factors that you use when you are deciding between equity sources, Said are the factors which you are using when you have to decide between debt sources, and CD-RAG are the factors that you have to use when you decide between debt and equity. Wow, so excellent, okay? So having said that, sources of finance options are available to the finance manager, and through this finance manager will take the financing decision. But remember, these sources are not free for the company. Obviously, there is a cost involved in that, and to assess their costs and things like that, you are going towards cost of capital. And remember, we work out the ratios as well, because when you have to decide whether you have to go for debt or equity, you have to consider the impact on your ratios. What ratios are important? Like return on capital employed, like interest cover, like financial gearing, like you have operational gearing, like you have interest cover, like you have dividend cover, like you have earning per share. So these are the ratios that you consider before you take decision like these. Price earning ratio, earning yield, all these ratios are important to consider when we take decision relating to the financing ones, okay? But as I mentioned, the cost is there. So let's now move towards the cost of these finances, and that is cost of capital. So first, let's start with the cost of equity. Now, equity sources of finance. Now, let's look at the cost of equity. So how company will work out the cost of equity if company is going for equity? Obviously, equity is not free for the company. Company needs to pay the cost. So how to work out the cost? We have cost of equity. You work out KE using two methods: dividend valuation model, DVM, and second is capital asset pricing model, known as CAPM. If I start first with DVM, so how do you work out KE using DVM? If you remember, write in the comment section. There are two methods. One is constant dividend method, where you assume dividend will not change and you work out the KE. So the formula of that is, you remember the formula, guys? KE is equals to D divided by P naught. And if you're using fixed growth in dividend formula, so in that case, KE is equals to D1 divided by P naught plus growth rate. So growth rate is something that you will be given, or you might need to work out. There are two methods to work out growth rate. The first is dividend, past dividend pattern, and second is earning retention model, okay? So if you use DVM as a method of KE, you need to remember a very important thing that can come in your paper is that DVM uses share price, which is X dividend share price. And you might be given a question where you have cumulative dividend share price. So what is the difference between X and cumulative dividend? It's very simple. If the question states that company has already paid the dividend, so this means the share price will be X dividend. But if the question says that company is about to pay the dividend, this means share price is cumulative dividend share price, and you have to deduct the dividend portion to make this X dividend share price. So using DVM as a method to work out KE has certain drawbacks, as number one, assumption of growth rate might be wrong. The share price that you are using, P naught, might be wrong. And the third is DVM is not considering earnings, because if you have earnings, if you have profits, then too you can pay the dividend. The other method is CAPM, a very famous method, capital asset pricing model. So how do you work out KE using CAPM? What is the formula? So the formula is KE is equals to RF plus RM minus RF into beta. So what is RF? RF is, guys, come on, can you write in the comment section? RF is risk-free return. What is RM? RM is overall stock market return. What is RM minus RF? It represents equity risk premium or market risk premium. What is beta? Beta is a measure of risk. If beta is exactly 1, if any company's beta is exactly 1, this means the risk of that company is equals to stock market average risk, and the return will be equal to stock market average return. But if beta is more than 1, this means that that company risk is more than the stock market average risk, and the return will be more for that company. If beta is less than 1, This means that company's risk is less than the stock market average risk and the return will be less than that. So capital asset pricing model is a very good model and it is superior to DVM because it considers the market-based risk and return. Market-based risk and return. If I just give you a quick idea what CAPM does actually. So CAPM gives you two types of return. One is the return to cover time value of money, that is covered by RF, and second return that you get is by taking additional risk in investing in equity market, that is being measured by RF, that is being measured by RM minus RF into beta. So what type of risk do you take when you invest in an equity market? So you take business risk that relates to the nature of the business, and you take financial risk, risk of debt that the equity investor is facing. Okay. So if I just move ahead with CAPM and go into the details of CAPM, there are two types of risk to understand. One is systematic risk. Guys, do you know what is systematic risk? Systematic risk and unsystematic risk. A quick one if you can write in the comment section. CAPM provides you the return for systematic risk. Yes, and it doesn't provide you the return for unsystematic risk. Now let's understand why. Unsystematic risk is a one that relates to a specific firm or an industry, okay? And this risk will be diversified by the shareholder by using diversified portfolio. So shareholder can themselves avoid this risk. Now, systematic risk is a risk that relates to entire global economy, which means this is the risk that investor cannot diversify on their own. As an investor, you cannot diversify this risk on their own, so you go for systematic risk return. But this systematic risk varies company to company. Okay, so what is portfolio? So there is theory known as portfolio theory, which says that there is a total risk that the investor is taking. In this total risk, there is systematic risk and unsystematic risk. Systematic risk is the one that diversified portfolio theory cannot avoid. So CAPM will provide the return, whereas unsystematic risk is a return. Unsystematic risk is the one that shareholder can diversify through portfolio theory, which means the shareholder will diversify its investment, will not invest completely in one industry or one market. In fact, will diversify its investment into different industries and different markets, and this is how it can diversify unsystematic risk. Having said that, CAPM seems to be better technique than DVM, but there are certain drawbacks. Drawback number one is that, it doesn't covers unsystematic risk. Number two, it does not differentiates between capital gains or dividend. It does says return, but never tells you what kind of return, whether it's a dividend return or capital gain return. So the question is, why is this important for you as an investor? It's important for you as an investor because different returns have different tax rates. Okay. Third is it uses beta, and beta is an estimate. Beta is an estimate, so might be results in wrong decision. But there are very much positives, and the positive number one is it incorporates systematic risk. Positive number two is it is considering market-based risk and return. Positive number three is it is used for risk-adjusted cost of equity. So the question arises now, what is risk-adjusted cost of equity? Okay, what is risk-adjusted cost of equity? So guys, you need to remember what is risk-adjusted cost of equity. So when you use risk-adjusted cost of equity, it's very simple answer. When the business risk of the investing company and the project will change. So if there is a change in the business risk of the investing company and the project, you will go for risk-adjusted cost of equity. So you need to remember the situation when the business risk of when the business risk of the investing company and the project is same, so investing company is allowed to use its cost of capital for the calculation of NPV of the project. But if there is a change in the business risk, then you have to go for risk-adjusted cost of equity. How you work out that? There are certain steps. Let's quickly recall the steps. Step number 1, you first find out proxy equity beta. Proxy is what? The target company's industry beta or the target company's competitor beta. What is a target company? I would say the investment that you are making in a project that is known as a target company. So you use proxy equity beta, and proxy equity beta means a beta which is an equity beta, and this equity beta is the one that includes business risk as well as financial risk of the proxy. So step number 2, you de-gear the beta. You de-gear equity beta and you make this asset beta. What is asset beta? Asset beta, you know what is asset beta? Asset beta is a beta which includes business risk only. Okay, so once you de-gear it, it becomes asset beta of the proxy company, which includes business risk of the proxy. Then what you do, you incorporate the investing company financial risk into this beta and you re-gear it again, and you re-gear it again. Once you re-gear it again, so again it becomes equity beta, but this equity beta is a mixture of two things, which means it includes business risk of the proxy that has actually changed, and it includes the financial risk of the investing company. So it is known as risk-adjusted beta, which is what? Business risk of the proxy and financial risk of the investing company. You then use this risk-adjusted beta to work out risk-adjusted cost of equity, and further it is used in calculating risk-adjusted WACC. So yeah, CAPM is very useful when the business risk of the project and the existing investing company is changed. Now let's discuss how to work out the remaining things in a WACC. So it's very simple. After calculation of KE, then we have calculation of KP. So we work out cost of preference shares. The formula is very much simple. Dividend divided by share price. Then the next is cost of debt. You work out cost of debt. In cost of debt, my friends, you need to remember that whether it will be very much important to find out that you are working out cost of debt for tradable or non-tradable. So if it is non-tradable, so that is a bank loan. So you need to work out the cost of debt for a bank loan. So do you remember the formula? What is the formula to work out bank loan KD? So the formula is interest rate 1 minus tax. Now why are you doing 1 minus tax? So remember, in every calculation of KD, we do 1 minus tax just because interest is tax allowable expense. Interest is an expense on which you get tax saving, and because of tax saving, the cost of debt for the company goes down, and this is the reason why cost of debt is cheaper than cost of equity. Okay, so for bank loan, the formula is very simple. As I mentioned, interest rate into 1 minus tax. You will be able to recall these things. Okay, but now if you're working out the KD for a tradable debt, so the first tradable debt known as bond is irredeemable bond. The KD of irredeemable bond is worked out by using a formula. What is the formula? It's very simple. Interest amount 1 minus tax divided by market value. Because it is tradable, so it will have the market value. Then the second one you have is redeemable debt. Redeemable KD will be worked out using IRR. Yes, IRR. So what you do, you work out two NPVs. The first cost of capital you can use is 5%. On this 5%, if you get positive NPV answer, you just double it, make it 10%. You will get negative NPV answer, and you can work out the IRR through the IRR formula. But if at 5% you get negative NPV, then just reduce that, maybe 2, you'll get positive NPV, and then you can work out the IRR. I hope you are recalling what I'm saying here, okay? So, redeemable debt, KD, is worked out using IRR. When it comes to convertible debt, yeah, it's very much simple. In case of convertible debt, everything remains same as redeemable debt, with the only exception is that in the last year, in the last year of the bond maturity, the bank will have two options, either to convert the debt into shares or to redeem the debt. Okay, so now obviously bank will select higher of options. So you perform a calculation of redemption, the cash option, and the conversion option, and then you compare these two. Higher of will be selected. So in the last year you use conversion or redemption, depending which is the higher value, and you work out the IRR and KD. So once we have done the calculation of all sources of debt finance, it's time to work out weighted average cost of capital. The steps are, first of all, calculate cost of each source of finance. Number two, calculate the weights. What are weights? Either the WACC will be market value based or the WACC will be book value based. So you have to look in the question. Market value is preferred over book value because market value represents current opportunity cost of finance, whereas book value is historical, and you can say that book value actually understates your value and yes, your WACC as well. So having said that, market value is better. Then you work out the weights for equity, preference shares and debt, and using that you work out WACC. WACC is basically the cost of capital, the minimum cost of capital that the company should be covering if it would want to satisfy its investors, that is bank and the shareholders. So in WACC then comes very important theories known as the capital structure theories. So what are capital structure theories? The first thing you need to remember is the basic question. Now what is the basic question? The basic question is, what is the best optimum capital structure? How much equity you should have? How much debt you should have? So the basic question is, what is the best optimum capital structure? Okay, so the optimum capital structure will be decided by different theories. The first we have is traditional theory. Traditional theory says that the optimum capital structure is a one when WACC is lowest and market value is highest. WACC is lowest and market value is highest. Okay. Then comes M&M theory, no tax and with tax. So M&M no tax says that there is no as such optimal capital structure, but it says that at any level of debt or equity, the WACC will remain constant. Okay, because the benefit of debt will be offsetted against the rise in cost of equity. Then comes M&M with tax. M&M with tax, which says that yes, the optimum capital structure is 99.99% debt, which means the more the debt you take, the more advantage you get. The benefit of debt is always better than the increase in cost of equity. Okay, and then comes the pecking order theory, which again says that there is no optimal capital structure. It tells you the sequence. First go for retained earnings, then use debt because it is cheaper, and then use equity because it is expensive than debt. So through this traditional and M&M and pecking order theory, we are able to understand the optimal capital structure that the company should follow. I hope up till now the recap of WACC, the recap of business finance, sources of finance, and the recap of investment is clear. We have understood how to take investment decision, how to take financing decision. I hope things are clear. It is giving you the confidence. Please share your feedbacks. Please share your feedback. The effort that I'm making, I hope it is going good for you. You can see my energy right now, the way I'm giving you the revision of entire thing in one slide. So hope this is going good for you people. Please do give your feedback in the comment section below. Okay. Now let's start with business valuation. Very important decision of investment again. You as a finance manager should be able to value the business, or you should know how to value the business. And this is very important when it's a case of acquisition, or it's case of a merger, it's a case of litigation. So you need to understand the valuations. So yeah, the first group of valuation that will help us to value is known as cash-based valuation. Cash-based valuation is a one in which you will be Working out the value using the cash option. So first we have discounted cash flows here. Discounted cash flow is a method through which you can work out the value of a business by working out the discounted cash flows like NPV. Then you have DGM, which is also similar to DVM. Now here it's very important that the DVM that you have covered here and the DVM that you will cover here is totally different, because when you were in VAC, you were required to work out the cost. Okay, you were required to work out the cost. Are you sure about it? Cost. But now you will be working out the share price. So in cost, you were given with share price and you used to work out KE. But here it's vice versa, and that is here now you will be given with the cost of equity and you will work out the share price. So in VAC, you had the mindset of a company, okay? You had a mindset of a company, and company will work out the cost of finance. But in valuation, you have the mindset of investor, and for investor, you will be working out the share price. So cost will be given to you and share price is what you need to work out, the value. So dividend valuation model will be used here, and this time again from calculation perspective, there are two methods. One is constant dividend. So the formula now will be share price P naught is equals to D divided by KE, okay? If you're using fixed growth in dividend methods, so the formula here will be P naught is equals to D1 divided by KE minus growth rates, okay? So here you're working out the share price. So there are certain very important assumptions that we should be covering for DVM right now. The first assumption is that DVM assumes dividend is the only income stream given to the shareholders. Secondly, it says that dividend, as I mentioned, that dividend is the only income stream, so that dividend will remain constant or will grow at a fixed rate. And the third very important thing is that dividend will be paid in perpetuity. So you need to remember that it will be paid in perpetuity for the shareholder. So using DVM to work out share price is useful, especially for minority shareholders. Minority shareholders are entitled to dividends only. So DVM as a method of valuation is good for minority shareholders, okay? What are the negatives of DVM when it comes to business valuation area? So remember that it is not useful for a company that doesn't pay dividend, because you cannot value the share price then. And then the other drawbacks include that the expectation of the growth rate and the cost of equity that you are using in DVM might be different to what that is being expected in the market. So it is a possibility that shareholders in the market are expecting a different cost of equity or a different growth rate compared to what you have used in DVM, okay? So that will result in different share price compared to the market share price. The second method is asset-based group, which says that you have to use the assets to work out the share price. So there are three approaches to it. This is book value, NRV, and replacement. Book value is historical value of net assets. What is net asset? You should know. All asset minus all liability is net asset, okay? So you have book value of net asset, which is historical. Then you have replacement cost, which represents the cost to set up an equivalent new venture. And then you have NRV, which is net realizable value, which is used in liquidation situation, which is used in a worst situation, that is you are closing the business. So what you will be left with if you settle all your liabilities through your assets, okay? So NRV is most useful out of all the three methods. So what are the disadvantages of business valuation group asset-based valuation? The first disadvantage is that it considers the tangible assets and ignores the intangible assets like goodwill. Secondly, it doesn't consider the earning potential of the asset. Yes, it says that there is an asset, there is a value of the asset, but it doesn't works out what is the earning potential of this asset. Okay, so this is the difference here. Now, the third we have is income-based valuation. So there are three methods here. First is PE ratio method of valuation, second is earning yield method of valuation, and third is dividend yield method of valuation. So remember, right now these three are considered as method of valuations. So PE ratio method of valuation is a one in which you work out share price using price earning ratio multiplied with earning per share. So remember, EPS will be of target company, whereas PE ratio will be of proxy. Okay, so proxy is what? Proxy means that target company's listed competitor or target company's listed industry PE ratio. Then you have the other method known as earning yield method. So in earning yield method, you work out share price, but it all depends whether you are using with growth earning yield method or without growth earning yield method. If you are given with the growth rate in the question, you have to use earning yield with growth method. Okay, so how will you work out the share price? So the formula of without growth is simple. That is, you will work out share price is equals to earning per share divided by earning yield. Again, this earning yield will be of proxy and EPS will be of target company. After that, the third one you have is dividend yield method, and in dividend yield method, you will work out share price is equals to DPS divided by dividend yield. Again, the dividend yield will be of proxy and DPS will be of target company. So the collective disadvantage of this method is that identification of proxy in all the three cases might be difficult. And one more thing, that is, if you are using a listed company proxy for valuing an unlisted company, so obviously because you are using proxy listed company PE ratio or earning yield or dividend yield, so the value that you will get will be an overstated value because you are using listed company proxy for valuing unlisted company share price. So there is a point where adjustment will be required. So these are the three groups. Now, there are other things that we value as well. So we can value preference shares. So we value preference shares. Now, again, you need to understand here that when we were in VAC, this preference share was used for calculating cost of equity. So share price was given here. I beg your pardon, cost of preference shares. So share price was given here and you are working out cost of preference shares. But when you are here in business valuation, so the mindset will change now because the mindset will be of investor here. So now KP will be given to you and you will be working out the share price. Okay, same goes for debt. For debt like bonds, like you were having three bonds here: irredeemable, convertible and redeemable. So when you were in VAC, the mindset was of the company. That is why we used to use interest after tax. But in business valuation, when it comes to debt, so the mindset is of an investor, which is the bank. And for investor, there is no tax saving on interest. So when you're working out the valuations of irredeemable, redeemable and convertible, remember, my friends, you will be taking KD before tax. Okay, so in share price, in valuation, you will be taking KD before tax, whereas in VAC, you'll be taking KD after tax, because here the mindset is of investor, whereas here the mindset, I beg your pardon, here the mindset is of the company which is using the funds, whereas here the mindset is of investor. So I hope it's very clear. Because of this one page of summary, it's easy for me to link the things here. So here the KD will be before tax because the mindset is of the bank, that is the investor. So we'll work out the value of irredeemable, value of redeemable and convertible by using before tax KD. So having said that, then we have certain market efficiencies here. There are three types of market efficiencies. So there is a concept known as efficient market hypothesis. Now, according to this concept, the share price fully and fairly reflect all relevant and available information. But there are three types of market. One is weak form efficient market. So if the stock market is considered as a weak form efficient market, so remember, all the shares that are traded on this market, their share prices will include past information impact, whereas no impact will be included for publicly available information in weak form or efficient market, and no impact of insider information. But if the market is a semi-strong market, so all the companies share that are trading in that market, the share prices of those will include past information impact, publicly available information, but no impact of insider information. And then comes the third extreme, which is a strong form of efficient market. So if the stock exchange is strong form of efficient market, the shares that are trading in that market will include past information, it will include publicly available information, and it will include insider information as well. So these are three types of market efficiencies. Remember one thing that is known as abnormal gain. Okay, so abnormal gain is important to consider. If you remember, the summary that I gave in my regular online classes was really easy for you to grip. So wherever you had a cross, which means if any type of information is not included, so on that information insider gain, on that information abnormal gain can be, abnormal gain will become active, and one can take advantage using the abnormal gain. Okay, so having said that, this was business valuation for you people. Now, day-to-day management requires working capital management. But before that, there are certain decisions of dividend as well. So as a finance manager, the three important work performed by the finance manager is investment, financing, and dividends. So for dividend decisions, it's really important to take the right decision, either to pay retained earnings as dividend or to reinvest it. So we have certain theories here. The first we have is known as Irrelevance Theory. Irrelevance Theory is a theory which says that shareholders are indifferent whether you pay them dividend or not. They are only concerned about wealth increment. So irrelevance theory is used, or it is based on the assumption that the market is a perfect market, which means there is no transaction cost, plus it says that there are no taxes, and a perfect market means that investors are completely aware of the director's decision. So this means shareholders are indifferent. They only want share wealth. They only need wealth increment, either that comes from dividend or capital gains. Okay, so this means if company doesn't pay the dividend, they know that company will reinvest that, and they will be compensated by the share price increase because of the investment that the company will make, which means if they are not getting dividend, that will be compensated by share price increase because of the investment. And if company is paying the dividend to them, so they know that the company will take equity, new equity will be raised by the company, and because of that equity, EPS will go down and share price will go down. So the dividend that they received will be compensated because of the decrease in the share price, and again they are indifferent whether they get dividend or share price increase. So they say that according to irrelevance theory, if anybody still wants the dividend, so they can manufacture dividend, which is known as manufacturing dividend. You can sell your shares anytime, and that capital gain is your dividend. The other school of thought that comes here is known as residual theory, which says that first the company should make investment in positive NPV projects, and last, if it is left with, then can pay as dividend. Then comes relevance theory, which says that no, dividend is extremely important for the shareholder. It is based on the assumption that shareholders, the market is imperfect and shareholders are not aware about all the decision of the directors, and yes, shareholders will react because there is taxes as well and transaction costs as well. So according to relevance theory, because it's imperfect market, a cut in dividend without properly informing the shareholder will result in negative signaling effect, which means that shareholder will consider that negatively and they will perceive, oh, something is bad going on in the company, and they will sell the shares. They might sell the shares, which can reduce the share price. So the reason why they react is number one, because they are dependent on the company in terms of its liquidity, because they have a liquidity preference. A cut in dividend affects their liquidity, and that is why they react. Or the reaction might come due to their tax planning gets affected, because those investors who are wealthy investors and have made investment just because of capital gains, those wealthy investors who have made a lot of investment and they want dividends in return. So because dividend is, for example, a tax saving for them, because the tax rate on dividend is less compared to capital gains. So any cut in dividend means that their tax saving advantage, because the tax rate is less on dividend, will go, and they will not prefer capital gains because of the high tax, and that is why their tax planning gets affected. So they react. Okay, so these are the two reasons for reaction. One is liquidity preference and second is tax planning. So what relevance theory says, it says that if you want to make them happy, so always inform them and use stable or a rising dividend policy. Stable or a rising dividend policy. Okay. Having said that, then we have the management of day-to-day things known as working capital. Yeah, working capital is the day-to-day management of the operations. So working capital is a formula which is basically current asset minus current liability. So current asset includes key components like inventory, receivables, and cash. Current liability includes key component like trade payables. Okay, so let's start first with inventory here. So in case of inventory, it is important to manage inventory at day-to-day level. So you have economic order quantity known as EOQ. My friends, economic order quantity basically is that reorder quantity that will indicate such a reorder quantity where your ordering cost and holding cost, the sum of these two will be lowest and these two will be same. So there will be a 2S rule that will be applied here. Sum of these two will be lowest and these two will be same. Secondly, you can use benefit of bulk discount to reduce your cost of inventory. When I say cost of inventory, so it includes the purchasing cost, it includes the holding cost, it includes the ordering cost. So if you add all, makes up your cost of inventory. So when it's bulk discount, so you need to work out the cost of inventory using discount, and you compare with EOQ, because normally EOQ results in a lower cost, but in case of bulk discount, there's always a need to check which will result in lower cost. Okay, then we have just-in-time policies, just-in-time procurement and production, which says that inventory could be managed through just-in-time. So using just-in-time, what benefits will you get is that you will not keep up your inventory, so there will be no holding cost, very less holding cost. Plus just-in-time means that you will not be keeping inventory, so your scrap will go down eventually, your wastage will go down eventually, your material handling cost will go down much eventually. Plus, because your cash will not be tied up in inventory, so your finance cost will be saved. Yes, it will be saved. Okay. Then very important is receivable management for a company. So there are 2 points written here. First of all, 7 factors. You remember that we have covered in my regular online classes. 7 factors when you're setting up a credit control policy for receivables. Okay. So the first is, if you remember, right in the comment section, the first is administrative cost of the credit control department. Second, you look at the competitor credit terms. Then you consider, before setting up the policy, the cost and the benefit of extending the credit period, the cost and the benefit of allowing further discount. Then you look at the expertise available, you look at the company's current liquidity position, and the risk appetite of the company. So considering these 7 factors, you set up a credit control policy for the company. Now that credit control policy, once established, will include 4 things, okay? Will include 4 things. So you can see a shortcut here, CAMS. The first is you assess the credit worthiness. So A, assessing credit worthiness. So there are 7 ways to assess credit worthiness. Examples include, number 1, you can take a bank reference, you can take the trade reference, plus you can personally visit that company, you can further find any press comments about that company, you can look at their financial statements, plus you can use credit rating agencies, you can give them credit scores, and through this you can assess their credit worthiness, okay? The second is setting credit limits, which is S in this word CAMS. So S is setting credit limits. After assessing the credit worthiness, you assess the credit, you set their credit limit for the new customers, and even if your existing customer comes to you for the extension of credit, so you consider that request as well. So here you need to perform a quick calculation in the exam as well, where your existing customer requires you to extend the credit period. So what you do, you compare the benefits of getting more credit, giving more credit, which basically means increase in contribution, and you compare that with the cost. So the cost might be increase in bad debt, and the cost because of increase in finance cost, as more cash will be tied up in receivables because of extending the credit period. And you take a decision on the basis of cost versus benefit, okay? Having said that, my friends, the next you have is the it's the collection of overdue debt, which is C of the CAMS. So collection of overdue debt means that once the deadline is done, the amount is overdue. So what you can do, you can basically contact your customer through setting them reminders by phone calls, okay? Plus you can personally visit them. If they are still not giving you, you can use third-party agencies, external agencies like factoring, invoice discounting, credit insurance, or you can go for a legal action, okay? But sometimes what you do to make your receivable process simple, you offer them early settlement discount, and this discount is an attractiveness for them to pay you earlier. So here again you need to calculate the benefits of giving discount, includes decrease in bad debt, decrease in administration cost, plus decrease in finance cost as well, compared to the cost of discount, and you take a decision. Sometimes you need to use external debt agencies like factoring. So Factor is a third-party company that gives you this receivable management services. So from Factor, the first service that you opt is administrative and credit control and invoicing. So Factor third-party company will do entire administration for you. It will include the invoicing, dealing with the client, and collection from the client. So this administrative includes recourse and non-recourse service. Recourse service means that the bad debt would be the responsibility of the company, whereas non-recourse means that bad debt will be the responsibility of the factor. Because in non-recourse, bad debt is the responsibility of the factor, so non-recourse is expensive, obviously, compared to recourse. The other service that is also mandatory in your paper is factor financing, where you are required to take financing from the factor. So instead of your own bank, you take financing from the factor, which is a bit expensive, and that is why you use additional cost on factor finance as your cost option, as your cost criteria for taking a decision. So you compare the benefits of factoring with the cost of factoring. Remember, recourse and non-recourse has a major difference, and that is, number one is of bad debt, because in non-recourse, bad debt is responsibility of the factor, whereas in recourse it is the responsibility of the company, and second is the factor fee. So what advantage factor provides a company? Obviously, it provides you financing, plus through that financing that you get earlier, From the factor, you can ensure your optimum inventory levels. You can buy inventory very promptly. Secondly, factor is if it is a non-recourse one, obviously the bad debt, it will be the responsibility of the factor in that case. But there are certain problems of factor, which means that if factor is providing you a non-recourse service, then factor is responsible for the bad debt, and here factor becomes strict, might not treat your customers well, and this can deteriorate your image and reputation in the market, and goodwill will go bad as well. Okay, so this is monitoring the credit system. So this is a collection of overdue debt. Then comes monitoring the credit system, which means that on a continuous basis you need to perform aging analysis. On a continuous basis you need to perform, you need to look at the credit utilization reports, that how much credit have been utilized by your customers, and you have to look at their payment methods and how much payment they have made. So this is basically elements of credit control policy known as CAMs, which is in front of you. A for assessing, S for setting credit limit, C for collection of overdue debt, and M is for monitoring credit system. As I mentioned, receivables, payables are extremely important as well. So it is important to manage payables as well. In case of payables, it is very important to strike a balance between liquidity and profitability. In case of payables, because now you need to pay, so you need to maintain good relationship with your suppliers, so that if you can delay the payment, so it will not deteriorate your reputation. Plus, in case of payables as well, there is an option that you have to consider, that if you make payment early and you get the discount, so should you take the benefit of the discount compared to the cost that will arise. Okay, so now after this we can move towards cash. So cash management is extremely important again. Why you hold cash? So there are three reasons why we hold cash. You can see here TPS. You are holding cash, number one, transaction motive, which means that you are holding cash for the day-to-day management. Then you have precautionary motive, which means you are holding cash for the bad times as a buffer cash, precautionary motive. Then you have S, which means you're holding cash for speculative motive, which means if you need to make any investment, you need to have cash in hand for that. Okay, so these are the reasons for holding cash: transaction motive, precautionary motive, and speculative motive. Now, how do we handle cash? So there is a management of cash which is done by, number one, using Beimel's model, very much similar to inventory EOQ. So Beimel's model is a model through which you manage cash. So how do we work out the answer using Beimel model? So yeah, it's very similar to the same formula of EOQ, which is 2 multiplied by D multiplied by CO divided by CH. So through this Beimel model, we work out the figure of cash. Now what that figure is, so remember, if you're using Beimel model, if you use the same formula, so now there will be a small change. Your cost of ordering will be your transaction cost in cash, and your holding cost will be holding cost of cash. Okay, that will be holding cost of cash. So whatever answer you get from Beimel model is basically what? It is the amount by which you should transfer the cash between the investment account and the current account, because the assumption of Beimel model is that for day-to-day management, for day-to-day expenses, you will be using cash from your current account, whereas if you are not using it, you can make an investment of that cash in your investment account, maybe your deposit. So the answer of Q that you get from this formula is basically the amount of cash that you will move between your investment account and your current account. So remember, if you use this model, and the answer that you get, that answer of cash will ensure two things. That is, 2S rule will be applied here again, which means your transaction cost and your holding cost sum will be lowest. So it will lower down your holding and transaction cost, and these two will be same. But the biggest problem of bimal model is that it assumes that the need of cash is certain. It assumes that the demand for cash is constant, which is not the case, okay? The demand for cash is not constant. It will vary. So that is why we have another model known as Miller-Orr model, and this model is basically a one that assumes that cash requirement will fluctuate. Cash requirement will fluctuate. Cash will not be uniform every time. So that is why it sets certain limits known as upper limit and lower limit. So what it says that there is an upper limit, there is a lower limit, there is a return point. Now very quickly listen. It says that return point is the best level of cash. Now if your cash is increasing from this return point and it reaches the upper level, this means this is the level which is considered as too high level for holding cash. So that is the point where you should make investment, where you should make investment from your cash and bring the cash balance back to return point, okay? So when you reach upper limit, what you need to do, my friends, write in the comment section. We need to make the investment and come back to the return point, okay? Now, it says that once your cash is going down from return point towards your lower level, okay, towards your lower level. So this is the point where you have too less cash now. So what you do, quickly sell the investment that you have made earlier, quickly sell the investment that you have made earlier by the amount through which you come back to return point. So this allows the fluctuation of cash, and this fluctuation of cash, which is the fluctuation between upper limit and lower limit, this fluctuation is known as spread. What is it known as, guys? It is known as spread. The fluctuation between upper and lower limit is known as spread, and through this spread you can manage the fluctuation of cash, okay? So in a question you might be required to work out spread. It has a formula available in the paper. Upper limit and lower limit is usually given to you. You can work out the return point. Then comes cash budget. So cash budget is what? Cash budget is a method through which you can forecast the future cash position. Maybe 3 months later, how much cash you will have. Maybe 4 months later, how much cash you will have. So cash budget is used for predicting the cash after a certain time period. Once you have identified the cash, whether it's a surplus or it is a deficit, then you can take certain important actions. So for example, if you have a short-term cash surplus in coming months, so you can use that surplus somewhere. Maybe you can increase your sales, okay? If you have a deficit, short-term deficit of cash, so you can just cover up that deficit by improving your receivables and selling your inventory faster, okay? That will help your cash. If it is a long-term surplus, so you can invest this in long-term investment. If it is a long-term deficit, it's a long-term deficit, then obviously there are certain loss-making products that you have to sell, or you have to take long-term loan. So by this cash budget, you are able to understand the future cash position and respective actions can be taken from there. Now, my friends, while making a cash budget, remember, always consider cash flows, cash inflows, cash outflows. So it is really important to ignore non-cash flow items like gain on disposal, like loss on disposal, like depreciation. Always take everything that relates to cash. Plus, always consider timing of cash flows. Timing of cash flows, which means you can't use financial accounting principles, which means you sold something today, but you will receive cash 2 days later. So your revenue will be recorded today, but for cash budget perspective, your cash inflow will come after 2 days. So you have to consider after 2 days for that, okay? So this is how we manage working capital. This is how working capital management is done. And this is in front of you. I hope you understand what I'm saying here. Now we are moving towards the last area of risk management, a very crucial area. of risk management, and you are seeing here the summary is almost done. You can see FM in one slide. I hope it is helping you to raise your confidence. You can see my effort in front of you, the way I'm explaining, the way I'm linking the things up, the way I'm giving you recap of each and everything. So that will help you really to understand FM and to recap FM before your tough paper of financial management, right? So do give your feedbacks if you like this effort by me, if you understand the things, if it is helping you a lot. Guys, I need your feedbacks in the comment section because you can see my effort. So what do you think? Will this be good for you? Will this help you to build up your confidence? Do mention your feedback in the comment section. Guys, what's your feedback up till now, please? Okay. So after this, let's move on towards risk management, one of the very important areas of the paper. So let's quickly discuss what risk management will include. It will include, number one, the currency risk. So what is currency risk? That is, exchange rate movement will have an impact on the business. So what kind of risk for currency you are facing? Number one, we are facing transaction risk. What is a transaction risk? Transaction risk means that when you enter into the contract and you settle it, when you enter into the contract and when you settle it, so between that time period, if exchange rate is moving adversely, so it is affecting your cash flows. So this is a transaction risk. Then comes economic risk, which is longer term impact of transaction risk, which means every time you buy and exchange rate adversely moves, this means in long run your business is getting affected by adverse movement of cash flows, and in long run your business will lose cash, which means in long run your business will not be able to maximize the shareholder wealth, which means shareholder wealth will be affected in the longer run if continuously over a long period of time exchange rate adverse movement is affecting your business cash flows. So economic risk is of two types. One is direct impact of economic risk and one is indirect impact of economic risk. Direct impact of economic risk means that you are dealing with a country and you're buying something from that country, so the exchange rate is adversely affecting your business again and again and again, and that is why your cost of imports is going down. So if your cost of import is going down against the local products, your business will suffer. So that is direct impact of economic risk. What is indirect impact of economic risk? So it's very simple. If you are selling some products to a different country, for example, you are selling products to USA and that USA company is also buying products from you and from the other country, for example, China. So for example, your business is going very well with USA customer, but there is a fluctuation in currency between Chinese and USA dollar, and because of that currency fluctuation, for USA customer, it is getting more useful and cheaper to buy from China instead of you. Now, your currency hasn't changed directly, but indirectly, because your competitor who is sitting in China, his currency fluctuation is making his product more cheaper for the USA customer. This means that your business will go down indirectly because USA customer will prefer buying from the Chinese company. So that is indirect impact of economic risk. Translation risk is a non-cash flow risk, and translation risk is basically a risk that arises when you convert your assets, your liabilities, your equity, your income, your revenue, your expenses at the time of consolidation, maybe at the year end, when you just revalue those in your own country's currency. So whatever values that have been affected adversely is known as translation risk, which is known as an accounting risk. Now, how to cover transaction risk? How to hedge yourself against transaction risk? That is a risk that you are facing in every transaction. So you have method number one known as forward contracts. So through forward contracts, we are able to hedge ourselves through transaction risk, which means by getting into a forward rate agreement, we lock a future rate with the bank, and whatever the rate will be at that particular time, our rate has been locked today. So today we lock a rate for 3 months time or 6 months time. So at that particular time of 3 months or 6 months, our transaction will be performed at that respective rate, whatever the rate will be in the market. So this is how we are hedging ourselves through forward contract, which means forward contract gives you the luxury of getting a locked rate. But at the same time, because you will be locked in a rate, so it's a binding contract, so you cannot discontinue the contract. For example, if exchange rate movement, you were thinking that it will move adversely, but you never know that if exchange rate has moved favorably, you cannot discontinue the contract because it's a binding contract, so you're locked into it. Okay. The second method is money market hedging. So what money market hedging is? Again, it might be a situation of it might be a situation of receipt or payment. You might need to pay in the foreign country, or you might receive some receipt from foreign country. So your hedging strategy will change accordingly. But before I move towards money market hedging, regular online students know my $1 million technique to solve. And yes, in seconds you get the answers. Obviously, you know the mindset behind that. So I just want to recall certain $1 million points that help you to find out the answer very easily. So first of all, what you will be looking here, whether it's forward contract or money market hedging, first thing that you will look here is the local currency. The local currency, you will find out whether pound is a local currency, whether dollars is a local currency, whether euro is a local currency or yen is a local currency. Okay, so first you will find out the local currency, and then you will look at the quote. So what kind of quotes there are? One is a direct quote and one is an indirect quote. Okay, so direct quote or indirect quote. So indirect quote means that foreign currency over local currency. Okay, so it's foreign currency in numerator, local currency in denominator. Okay, the second is direct quote, where local currency is in numerator and foreign currency is in denominator. So once you identify the local currency, you can quickly watch at the quote and you will find out whether local currency is in denominator, and if it is in denominator, it's indirect quote. But if local currency is in numerator, it's direct quote. So once you've identified the quotes, you all know, my regular students, that you need to apply very quick rules of bus and sub. You remember bus and sub. Okay, so bus is buying and selling, and sub is selling and buying. As you all know that the rates that are given in the paper, it's first the lower rate coming first and then the higher rate coming later on. So bus and sub rules you will follow. One more thing that I made really clear was when it's an indirect quote, you always need to divide to work out local currency. That is, foreign currency divide by the exchange rate and you get the local currency, whether it's a payment situation or it's a receipt situation. And in case of direct quote, I told you, you need to multiply the foreign currency with the exchange rate to get the local currency, whether it's a payment situation or whether it's a receipt situation. One more thing I need to add here, that if you are making a payment in the foreign currency, so what you will do, obviously, if you are making a payment in the foreign currency, so you need to buy the foreign currency, so you'll be using buying rate in that case. And in case of foreign receipts, so what you'll do in case of foreign receipts, if I live in Pakistan, so what I'll do keeping dollars in Pakistan? Nothing. So I'll sell the dollars in Pakistan. So in case of foreign receipts, I will sell. So I'll take selling rate. In case of payment, I will buy the foreign currency. I'll use buying rate, and rest people know how easy it then becomes to work out any exchange rate answers. Moving towards money market hedging, if it is a receipt situation, so I told you a very simple shortcut, BCD. Okay, BCD. So what is that? BCD. What is BCD? So it says that borrow foreign currency, now convert into local currency and deposit the local currency. Agreed? And if it is a payment situation, it's the opposite way around. Billion dollar point says it's the opposite way around, which is DCB. DCB means that deposit foreign currency now, convert into local currency and borrow the local currency. Okay? So you compare money market hedging with forward contract, and whichever results in a more beneficial situation, you go for that. In case of payment, you go for the lower cost option out of these two. In case of receipt, you go for higher option because it's receipt. So you go for higher option between these two. Then comes derivatives. So I'll come to derivatives at the last. Now I'm moving towards another area of transaction risk hedging, so that I cover other ways of transaction risk hedging other than forward and money market hedging and derivatives. So those other methods include leading and lagging the payment. Leading means making the payment or getting the payment earlier than the time period, and lagging means making the payment or getting the receipts later than the time period. Okay. The other method includes matching and netting, plus it further includes dealing in home currency or opening a foreign currency bank account. These are other methods to deal with transaction risk. Now the question is, why does transaction risk arises? Why exchange rate fluctuates? Now you know exchange rate fluctuates due to demand and supply situation in the market. So there are 4 different theories. One is interest rate parity theory. Interest rate parity theory says that you can predict the forward rate, and this is done by interest rate differential. So there is a formula. You can use spot rate multiplied by 1 plus foreign currency interest rate divided by 1 plus local currency interest rate, and you can work out the forward rate. So it says that country with higher interest rate will be subject to more depreciation of its exchange rate, which means nobody can take unfair advantage. Okay. Then comes purchase power parity theory, which is a theory which is used for predicting future spot rate. Okay, future spot rate. So what it is, you can work out future spot rate by current spot rate multiplied by 1 plus foreign currency inflation rate divided by 1 plus local currency inflation rate. So it says that you can work out the future spot rate by inflation rate differentials, and country with higher inflation rate will be subject to more depreciation of its currency. Then comes international Fissure effect. If you remember, international Fissure effect says that the real rate is same in all the countries. The real rate is same in all the countries, whereas it's the difference of the inflation rate that results in different nominal interest rates. Okay. And then comes expectancy theory, which says that in future time, your forward rate and future spot rate will be exactly equal. So this is known as 4-way equivalence theory, which says that everything is equal to all other. So IRPT, interest rate parity theory, purchase power parity theory, expectancy theory, and international Fissure effect, they all combine and make 4-way equivalence theory. Okay. The other risk is of interest rates. If you are dealing in the borrowing and lending things, so you might face interest rate risk. If you want to borrow an amount in future in 3 months time or 4 months time, so what is the risk you are facing? The risk that you are facing is the interest rate will rise. Okay, so this is interest rate risk. So how you hedge yourself? Number 1 is forward rate agreements. You hedge yourself through FRA, which means that you lock a future rate and with a bank. So whatever the rate will be in the future, your rate has been locked and you will borrow or lend according to that rate only. Okay. Then you have another technique known as matching and smoothing. So what is matching? Matching says that there are 2 types of interest rate, and this is well done by a bank. One is in floating interest rate and one is fixed interest rate. So what can bank do is that it can match its fixed interest rate assets with its fixed interest rate liabilities, whereas a bank can match its floating interest rate assets with its floating interest rate liabilities, and this is how it can hedge itself. Then is smoothing, which means that a company that deals with borrowing or lending, so what company should do? Company should take a balance. Company should take a balance of floating interest rate and fixed interest rate. Don't go for all loans using fixed interest rate, because if interest rate goes down, you will suffer. Don't go for all loans using floating interest rate, because if interest rate rises, you will suffer. So smoothing, go for a balance between fixed and floating interest rates. Okay. So this is how you deal with interest rate risk. Then you have yield curves, a very important concept, which says that there is a normal yield curve, which means that there is a normal yield curve, which means in short term the interest rates are low, whereas in long run interest rates will be higher. Then you have an inverse yield curve, which says that in short term your interest rates will be higher, in long run your interest rate will be lower. And then comes a transition phase, which is basically a yield curve, which says that your short term and your long term interest rates will be equal. So normal yield curve is basically a predictor of economic boom, which means in economy you are expecting boom in the future, because in long run interest rates are higher. People have a strong belief in the long term, whereas in inverse yield curve, it's a sign of economic recession, which means that people are not confident in long term. So that is why short term rates are more. Then comes the third one, which is a flat yield curve, which is a transition phase. Either you are moving from economic recession towards boom, or from boom towards recession. So these yield curves basically are determined by a combination of three theories. One is known as the liquidity preference theory, which means that people basically prefer liquidity. People prefer liquidity, which means if you invest in long term, you will take a higher rate because you are investing for a longer time period. And if you're investing in short term, so you will go for a lesser rate because your amount is stuck for a lesser period. Second comes the expectation theory, which says that it depends on supply and demand of the market. If people are expecting that in future interest rate will rise, so it starts rising. If it's people believe that interest rate will go down in future, so it goes down. Third theory is market segmentation theory, which says that markets for short term and long term are completely segregated. Those who believe in short term will remain in short term. Those who believe in long term will follow long term only. So they are totally market segmented. So based on these three theory combination, yield curve is determined. A yield curve is helpful for a business because you as a manager, as a finance manager, you'll get to know where the economy is moving ahead. You can plan for your loans and lending accordingly. Then comes a concept of gap analysis or gap risk. So there are three types of gap risk. It is asset sensitive position, liquidity sensitive position, and a balanced gap position. Normally it is applied towards bank because when bank lends something, so that is an asset for bank, and when bank borrows something, that is a liability for bank. Okay, bank borrowing is a liability, bank lend is an asset for bank. So if bank has more assets than its liabilities, okay, more assets than its liabilities, which means more lending than its borrowing, so it is known as asset sensitive position for a bank. More assets are good, but if bank assets are less than its liabilities, which means more borrowing done on which they have to pay the interest and less assets on which they will receive interest, this is liability sensitive position, which is dangerous for the bank. And when bank has an equal amount of asset and liability, equal amount of asset and liability means that it is balanced gap position, which means bank is secured here because it has equal amount of asset and liability. So you need to know when bank lends someone, bank gets interest rate which is higher to when bank borrows from someone, bank pays the interest and bank pays a lower interest rate. So it's simple. When bank will lend, it will charge a higher interest rate, but when it borrows at a lower interest rate, and the difference of that interest income and interest payment is the net interest margin that bank actually earns. Okay, so I hope this is clear to all of you as well. So this was about the gap risk. Now the last is known as basis risk. Now what is basis risk? Basis risk means that your hedging cannot be perfect, whatever methods of hedging you use, so that hedging cannot be perfect. So imperfect hedging is known as basis risk due to multiple reasons. You cannot completely eliminate your risk, okay, of interest rate rising or of exchange rate movement, so that imperfect hedging is known as basis risk. Now coming towards the last thing relating to both is derivatives. You can see derivative here and derivative here as well. So derivatives are another way through which company can hedge itself in currency and interest rate. So there are three other derivatives compared to what we have discussed before. The first is futures, which is currency futures or interest rate futures. There is options, currency options or interest rate options, and third is swaps, currency swaps or interest rate swaps. Okay, so futures is another derivative through which you can hedge yourself from the currency risk and interest rate. Few options are different because options give you the liberty of getting the advantage, and in case of disadvantage you can leave the options because the word is option here. Swap is basically exchange of interest rates between floating and fixed, or in terms of currency if I say, so exchange of currencies. So through these three derivatives you can hedge yourself. Swap is basically for long-term agreements. If you have 5-10 years agreement, you go for swap, you can hedge yourself towards swap. Interest rate options or currency options are normally considered expensive than futures because interest rate options or currency option require a premium to be paid because it's an option. You want to exercise, you exercise it. If you don't want to exercise, you don't exercise, but you have to pay premium on it. So it's normally expensive compared to futures. But for futures, again, future contracts are for limited currencies. It's not available for all kind of currencies and limited amounts. So contract sizes are fixed here. So it's a drawback here that the amount is fixed, contract sizes are fixed, and limited currencies are used in case of futures. Okay, so these are the derivatives which you use for interest rate and currency hedging, and this is entire FM Financial Management in front of you in one slide. You can see it's in one slide by Rizwan Maniya. I hope you like my little effort. This grand revision of F9 will definitely boost up your confidence before the exam, and it will give you a big lift for your preparation of exam. So I hope it's clear to all of you and you are happy when it comes to this revision. So guys, you all are finance manager, remember, and yes, keeping that in mind, you need to ensure that you need to think like a finance manager in the examination. Now guys, this is my WhatsApp number that I'm sharing here. Those who are not part of my WhatsApp group and they want FM support from me, they want FM support from Wi-Fi, so please note down my number. It's 92 plus 92 321 2436 266. Okay, so it's 2436 266 plus 92 321 2436 266. You can WhatsApp me if you are not part of my group. Once you will WhatsApp me, I'll send you the link. You can become part of the group for all kind of support that I will give you till the exam day. Before the exam night, I give entire support to all of the students, and yes, that's free support. So you need to be part of that. If you're not part of my WhatsApp group, just send me a WhatsApp message quickly here. I'll send you the link. Please do give your feedbacks. The only thing I require is your feedback. So please do give me your feedback, how this session was and did it help you? What do you think it will be good for you? And how's the summary? Yeah, how's the summary? So is the summary good for you? is confident booster for you. So please do give quick feedback about this summary. I would really love to see your feedback because you know the energy that I've invested here since so many hours, my energy, continuity, the way I'm speaking things, the way I'm linking. I need your feedback because this is my appreciation from you people. Please do give me your feedback how the entire session was, how it went for you, and will it help you to boost up your confidence or not. Okay? So thank you very much, guys. Best of luck for your examination. Do WhatsApp me for any questions you need to. Thank you very much. Rizwan Maniya signing off from Wi-Fi Studio. Best of luck for your paper. Bye.